We have with us the management of Deep Industries. Now, a new order win, 82 odd crore. It's a company which has roughly 1200 crores of an order book and has revenue of roughly 400 odd crore FY24. Let me welcome on board Rohan Shah to throw us some perspective with regard to this order in particular, as well as some of the comments made by the Oil and Gas Minister. Rohan Shah is the Group CFO and Director Finance at Deep Industries. Welcome first off, Mr. Shah. It's good having you here.
Thank you.
So talk to us about this 82 crore order as well as the traction you are getting. This order is obviously from ONGC. Execution period is 3 years. Talk us through how this order will get executed and what's the kind of traction of similar orders and what's the nature of this order.
Right. So the recent award received from ONGC is for workover rig services. So we have received 2 orders put together of having value around 82 crores to be executed over 3 years period. And these are 2 workover rigs to be deployed over 2 different sites of ONGC. And the mobilization period is around 180 days. So these 2 rigs can start operation in the next 180 days and start contributing in revenue.
Understood. And sorry, please go ahead.
Along with this, we had recently received some other orders for one drilling rig as well as one dehydration units and compression units. Put together, our order book is increasing only.
Understood. Got it. So traction seems to be good. It's holding up. Just with regard to margins on both of these orders which you've recently won, what's the kind of margin which you've historically clocked or which you're expecting to clock on these orders?
See, in our rig services business, our historic margins are in range of 42 to 45%, and we expect to continue similar kind of margin in these 2 contracts as well.
Understood. And with regard to traction, so of course, ONGC is one of your key accounts, key clients. What's the kind of interest that you are seeing? Is there a heightened interest compared to maybe a year or 2 back? Talk us through some of those. What's the sense like on ground?
Yes, so since last 1 year, we are seeing excellent traction in demand of our kind of services. With an increase in oil and gas production, our services are also in demand. And since last 1 year, we are observing that various kind of orders and expressions are coming up, and we are successfully getting many of those. So we believe for next 3 to 5 years, similar demand should continue, and we should get benefit out of it.
Got it. And how should execution start to play out? If you can talk to us on your overall order book. 1200 odd crore is the current order book size. Correct me if I'm wrong.
Sure.
So how do you plan to execute FY25-26, at least a 2 to 3 year visibility just in terms of execution that one can see? But just in terms of numbers, how do you expect the growth to come?
Right. So our existing order book, as you rightly said, is 1200 crore plus, and which gives us a clear revenue visibility of next 3 years. So current order book is sufficient enough to give a clear visibility of revenue for 3 years. And in addition to that, our bidding pipeline is also becoming healthy, and it is growing month on month. So further conversion from that bidding pipeline into order book will give an additional revenue visibility. So we believe last year we had grown 25% year on year, and we believe similar amount of growth we could achieve in FY25 and 26 as well.
Understood. So you'll go likely to 650 crore odd in terms of top line by FY26.
Yes, possibly, yes.
Understood.
We are very much optimistic, yeah.
Understood. And can margins, is it higher margin business contributing to these orders? Talk us through that as well. Not just these 2 in specific, but the order book as a whole, if you can tell us. Because your slightly higher margin business, the likes of natural gas compression and dehydration, almost a 60% margin on that business. So talk us through how will margins really evolve and what's the larger composition in terms of business within this order book?
Yes, so our overall margins are at company level. We remain maintaining EBITDA of around 40% throughout these many years. And in overall service mix, as you rightly said, gas compression and dehydration are having excellent EBITDA margin of around 60%. So at the end of the day, if my compression or gas processing business is contributing more in overall revenue mix, then there is all good chance to improve company level EBITDA going further. And since the traction from industries for all segments, we believe all segments put together will contribute in margins of company level. And we are quite optimistic that we can improve our EBITDA margins going further.
So overall margin 40% you seem reasonably comfortable guiding for net.
Correct.
Understood. I want to shift focus a little bit with regard to what the budget expectations from you are, because we heard from the oil and gas minister where he spoke about how oil exploration needs to be given more focus. What's your sense with regard to that, especially in India, because that's what he was essentially talking about?
Very true. The focus of our central government to become energy self-sufficient is very much visible since last few years. And we believe in upcoming budget, there should be further encouraging announcement to ensure increase in domestic oil and gas production. So we are quite optimistic on upcoming budget that there should be further policy changes and some encouraging announcement towards increase in domestic oil and gas production.
Okay, I want to try and understand what the risks to this 40% margin ought to be, because it's a high margin number. Talk us through how competition is behaving in this environment. Of course, you're one of the few which does what it does in terms of offers the services that it offers. But do you believe that heightened competition could compress in some way your margins, or could there be any other risks to margins in your view?
See, as a company, we have been maintaining this similar type of EBITDA margins for more than 10 years now. And since we are into a niche segment of service where our services are very critical for any oil and gas producers, we believe this segment should cater some handsome margins going further as well. And with regards to competition, since in India we have seen more than 3 decades now, we believe that competition will definitely come and play the role, but it will not have any adverse impact on our operating margins. And we are very much firm that we should maintain this type of margin for coming future as well.
Okay, I take your point. Now, if I were to again try and understand what your capacity utilization currently is at, and where are you investing essentially for the future? Again, to try and also get a flavor of what you're investing for the future from a perspective of which vertical, and therefore where will margins start to get better, and is there scope for that?
See, our capacity utilization in rig segment is almost 100%. So all rigs are deployed and utilized. With regards to gas processing segment, our capacity utilization is almost 80 to 85%, which is excellent for any industry. And going further, as I said before, we are getting traction in all segments. Each of them, we are getting good expressions, and we are bidding tenders for almost all these verticals. So I believe growth will come from all sectors, all verticals of our service portfolio.
Understood. And sir, capex plans, where are you reinvesting the surplus that you're generating?
See, in our business, capex is always backed by firm orders. So as and when we get firm orders, we try to invest into equipments, and we get those equipments to deploy on client sites. So like this year, we are adding 3 rigs in our portfolio. So this year we are doing capex of around 100 crores for these 3 rigs and a few other equipments put together. So going further, on the basis of award we receive, will continue to invest in increasing our equipment portfolio.
Okay, and just in terms of how are you going to fund the 100 crore? Is it going to be entirely internal accruals? You've taken on some decent amount of debt in the last 1 year or so on your balance sheet. Will you continue to expand that? What's the plan?
See, we'll definitely fund this capex partly from internal accruals and partly from debt. If we talk about overall debt size, we are very much comfortable. Our debt to equity is very comfortable, and we believe that our policy to be conservative on taking debt is helping us throughout. And so we always remain cautious on our debt profile. And over a period of time, we have seen that we have reduced our debt drastically in last few years. Currently, if we talk about March 24, we were almost net debt free.
Yes, I completely take your point in terms of net debt free, yes, and even debt levels seem to be quite low. So thank you so much, Mr. Shah. It's been a pleasure speaking with you and understanding, of course, the industry as well as some of Mr. Puri's comments and what potential the industry has.